Hello, Bruce. This is Bruce Simmons and Marie Jacobs. I'm a realtor with Sotheby's Realty, and Bruce is with American Liberty Mortgage, and we're here to answer what's going on with these mortgage rates. So I'm really glad Bruce is a partner, and he specializes in reverse mortgage loans, but he also knows a whole lot about the lending industry. So we just wanted to take 5 or 10 minutes and kind of talk about what's going on. And I'm Marie Jacobs, and I'm out of Boulder, Colorado with Liv Sotheby's Realty. And I cover the whole Front Range from Denver up to Fort Collins. So Bruce, welcome aboard. Thanks for being here.
Thank you so much for having me, Marie. I'm always excited to join you on these.
So what I know is that a few weeks ago, we were so excited because the Fed came out and announced that, we're going to lower rates 3 times this year. And the inflation rate has stayed kind of stable around 3% for some time now. And then today, everything blew up, didn't it? So why don't you tell us what's going on and what has to happen to get mortgage interest rates? And maybe a little bit about what's the difference between the Fed lowering the rate and what it does to mortgage interest rates? So I'm putting you on the spot here.
All
Take
right,
it away.
let's talk about your last question first.
Okay.
When the Fed changes the federal funds rate, that lowers the rate that banks loan money overnight. That's what that is basically, to each other, not to you or me. So what happens is, though, not necessarily an index, but it's a guide for other lenders saying, hey, money is getting cheaper. We can lower our rates as well. So it affects all the different possible indexes around. An index could be like the federal funds rate, the prime rate, coffee, the cost of funds index, the US Treasury index. That's the one that reverse mortgages uses. So all these different indices end up lowering or raising depending on what the rate does. And a lot of that is based though on expectations. And what happened at the end of last year really is when the Fed first started coming out saying, oh, we're anticipating lowering the rates 3 different times, basically a quarter each. So the rates we were thinking would be 3/4 of a point lower. That was kind of built in the first couple of months, that expectation of what rates are going to do. And then when it didn't happen, when some bad reports started coming out in February and then again in March, the rates have been trending up since March. But today they really blew up because the CPI came out, the inflation index, and it was a lot higher than what was expected. And people kept pushing it back. Oh, well, first the Fed was going to lower the rates possibly in March or at least May. Then it was June. Now we're looking possibly September. Honestly, I'm pessimistic about any lowered rates this year, unfortunately. I think we're in more of a long-term, like multi-year cycle that's going to keep us with higher inflation and higher rates for a little while. We're just going to have to get used to this 6 to 8% range just bouncing around. Right now, I think conventional mortgages are in the low sevens to mid sevens after today, possibly. That's where reverse mortgage rates have been. But real quick, I just want to touch on, as far as reverse rates for your clients that are anticipating maybe getting a reverse mortgage now or in the future.
And a reverse mortgage is for those people who are 62 years old or older, just for our audience here. So if you're not 62, you can't take advantage of this great funding.
Yeah, thank you for that. I forget, I get going, and thank you for bringing me back down to earth, Marie. So what happens though is the rates affect reverse mortgages differently than they do a conventional mortgage. With a conventional mortgage, as the rates creep up, well, the monthly payment increases and it's harder to qualify people income-wise. With reverse mortgages, what happens is there's no payment required. So the rates don't affect the payment. They can affect how much interest you're charged, because with reverse mortgages, you're still charged interest. You just don't have to pay it back. That's one of the beauties of reverse mortgages. But there's also, the rates affect the amount of money we're allowed to loan. As the 10-year Treasury inches up, the amount of money we could loan as a percentage of the value of the home inches down. So like today, this huge jump we had in rates today is negatively affecting the amount of money somebody could get from a reverse mortgage. Let's say we could normally loan you 200,000. Let's say last week we could loan you 200,000. Well, then this week happens and you owe 200,000 on your mortgage. We have to pay off any existing loans that you have on when you do a reverse mortgage. We're basically replacing your forward mortgage with it has a monthly payment and all that with a reverse mortgage. It requires no payment. But we have to be able to pay off your old mortgage with the new reverse mortgage. But what happens is if you owe 200,000 and we can loan you 200,000, well, now maybe we can only loan you 190. So you're 10,000 short for us to loan you enough to pay off your existing mortgage. And it really messes people up. Back in 2022, at the end, when rates first started going up, so many people were anticipating the Federal Reserve is going to lower the rates in 2003 or 2023. That didn't happen. We know they just kept inching it up all throughout the whole year. And unfortunately, I'm concerned that the same thing is going to happen this year.
So let's talk about, what does this mean for our buyers? Because what started happening in the last few weeks is this anticipation of better rates got the buyers out, and it even brought more sellers out. So we have about every week about 7 to 10% more listings coming on the market than last year. So we're solving a little bit of a problem there with more inventory. So that brought buyers out, plus this promise of lower interest rates. And the way I look at it is, if you buy this year and you have a higher interest rate and you can scrape along and do it, some of the sellers are offering buy downs, and we can talk about that a little bit. And most of the lenders, and I know your company is offering to refinance for free when the rates do come down. So it still makes sense if you can afford the monthly payment to go ahead and buy now, because that property will also appreciate. In our market, we're seeing appreciation rates that are through the roof. But even using just an average of a 4% appreciation rate, when really I'm seeing 9 and 10% in most of our markets. So just being conservative, a 4% appreciation rate on a $500,000 house is $20,000. If you wait to buy it next year, it's going to be 20,000 or more money to get that same property at a lower interest rate, right?
Yeah, exactly. And then that extra amount you're paying offsets any rate reduction too. So
Right.
why not do it now? And I tell everybody, it's buy the house or marry the house, date the rate, basically.
Right.
'Cause you can always change the rate. And I'm telling my reverse customers the same thing, because even though you're not getting as much money as you want now, if you can qualify, do it. Because we're not seeing home prices drop in Colorado. And I don't think
Right.
we're going to for a long, long time, even
Yeah,
with the rates.
and the way things have been going, I mean, I know that part of what drives inflation, which is driving that high interest rate, the inflation is going up because housing prices are going up. So everything is affecting it. The price of groceries, the price of vehicles, everything is keeping inflation high. So buy high and then refinance as soon as it starts to get into balance. It will at some point. We just thought it was going to be this year. Maybe it's not going to be until next year. Or maybe we'll get to September and see our first interest break, and that would be
awesome.
Spectacular.
Yes, it would. And that would really spur the market too. But I mean, think about a lot of my customers bought homes in the 80s when rates were 13, 14, 15%. They still bought, and they're benefiting from it today because they've got a ton of equity now. I mean, they benefited it throughout. But it's important that just get in the door.
Well, and the other thing that I didn't even mention is you're also, for that year, while you're waiting for the rates to come down, you're gaining equity, but you're also paying down your mortgage.
Yeah.
So you're going to have even more than a $20,000 conservative growth on a $500,000 property. You're going to have also that pay down of a mortgage. So it's always good to buy, regardless of what the interest rates are. It's a little painful to get that nut every month, but it's still the best thing to do, especially if you're renting.
Oh yes, I agree 100%. And if you're older and you're in a home that doesn't fit your needs anymore, let's talk. I mean, I know you've got some customers and they can benefit by, obviously it helps the market too, because they're moving out of a home that a new first-time home buyer might be able to move into, and they're getting a home that really fits their needs. And with a reverse mortgage, they may be able to do that without sacrificing a payment, because they're actually getting rid of an existing payment. So there's
Right.
all kinds of benefits to doing that. And just, I think, get in the house. That's the message for
And
this meeting.
yeah, right. Bruce is the best reverse mortgage guy I know. He's just so good at getting people, you're good at getting people to understand it. You keep it simple and explain it really well. And I'm going to get in my own, as you know, and you'll be my broker for that. So
I'm going
anyway,
to get mine too. So when I'm old enough, I'll do the same.
right.
Yeah.
So thanks for being with me today. This is really a great little snapshot of what's going on to help educate our folks that are listening.